put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The Friday Night Massacre. In the final hour before the weekend descended on October 10th, 2025, someone knew something that 1.6 million traders did not. While markets prepared to close and the world turned its attention away from trading screens, a ghost position worth $1.1 billion in short contracts materialized in the digital shadows. What followed in the next 60 seconds would become the most devastating wealth transfer in cryptocurrency history. And the question that haunts every trader who survived is simple and terrible. Was this panic, or was this predation? This is the real-life business story of how $19.3 billion vanished in hours, how a $60 million dump became a $19 billion massacre, and how the invisible architecture of digital finance was weaponized like a loaded gun pointed at the market's skull. October 10th, 2025, began like any Friday for the crypto market. Bitcoin trading near its all-time high of $126,000, institutional money flowing steadily through newly approved ETFs, and leverage positions stacked to record heights as traders bet on continued gains. The funding rates told a different story for those who could read them. Extreme greed, over-leveraged longs, and a market structure fragile as glass stretched too thin. Someone was watching those numbers very carefully. At 1427 UTC, large whale positions began establishing massive short contracts. The timing was surgical. US markets were still open, but barely. European desks were closed. Asian traders were asleep. The 24/7 crypto market stood alone, isolated from the traditional financial system that might absorb shocks or provide liquidity when everything went wrong. Then, at 1457 UTC, President Donald Trump's account posted an announcement that would serve as the perfect cover. A threat of 100% tariffs on all Chinese imports, paired with new export controls on critical software. Markets trembled. This was the match. But the real explosion had already been carefully prepared, hidden inside the pricing mechanisms that every leveraged trader trusted with their financial lives. What the on-chain analysts would discover later reads like a financial crime thriller written in blockchain data, because buried in Binance's systems was a vulnerability that had been publicly announced 8 days earlier. On October 6th, the exchange had revealed it would transition 3 specific assets, USDE, WBETH, and BNSOL, to Oracle-based pricing to eliminate manipulation risks. The implementation date, October 14th. The vulnerability window, 8 full days, where the old system remained exposed, where collateral valuations still relied on Binance's internal order book, rather than external price feeds. 8 days to position, 8 days to prepare, 8 days for someone who understood infrastructure vulnerabilities to build the perfect trap. At 21:15 UTC, exactly when liquidity was thinnest, when market makers were pulling back, when the machinery of crypto trading was most vulnerable, the attack began. Someone dumped $60 million worth of USDE tokens directly onto Binance's order book in a coordinated assault. Not on Coinbase, not on Kraken, only on Binance, where the internal pricing oracle would register the manipulation as reality. USD's price collapsed to 65 cents on Binance, while remaining perfectly stable at $1 on every other exchange in the world. The same pattern hit UBETH and Bensol, prices cratering exclusively on Binance, while the rest of the market showed normal valuations. This wasn't market panic. This was surgical exploitation of a known weakness. executed with the precision of someone who understood exactly how Binance's unified account margin system would respond to manipulated collateral prices. What happened next unfolded with algorithmic brutality. Binance's automated system saw the USD price crash and instantly revalued billions of dollars in collateral positions. Thousands of leveraged accounts that had been perfectly healthy seconds earlier were suddenly flagged as under-collateralized. The liquidation engines activated. Margin calls cascaded through the system. Forced selling began. In the first 60 seconds after 21:15, UTC $3.21 billion in positions evaporated. Not over hours, not over minutes. In 1 minute, wealth equivalent to entire countries' GDP vanished as automated systems executed their programmed responses to manipulated data. But here's where the real nightmare reveals itself, where this story transforms from a market crash into something far more calculated and sinister. The $60 million dump was just the trigger. The real weapon was recursive leverage, a hidden structure that would amplify that initial manipulation by a factor of 322. Binance's unified account system had allowed traders to use yield-bearing assets and stablecoins as collateral for leveraged positions up to 10 times their initial value. Traders who thought they were being conservative by using stable collateral had unknowingly built towers of leverage on foundations that could be manipulated. When USD depegged on Binance's internal systems, it didn't just affect direct USD holders. It contaminated every position that used it as collateral, every loan that referenced it, every margin calculation that depended on its assumed stability. The liquidation cascade spread like a financial contagion. As Bitcoin positions were liquidated, Bitcoin's price fell. As Bitcoin fell, more margin calls triggered. As those positions liquidated, altcoins crashed harder. Layer 2 tokens like Arbitrum and Optimism lost up to 70% of their value in minutes. Smaller altcoins, coins in the top 100 by market capitalization, briefly touched prices near zero as all liquidity evaporated simultaneously. 97% of the top 100 cryptocurrencies fell in tandem, a synchronization so complete it defied random market behavior. Dogecoin cratered 50% before recovering. Solana lost 40%. Ethereum dropped 16% in under an hour. Bitcoin, the supposedly stable, institutional-grade asset, plunged 13% from its peak. The trading infrastructure itself began to fail under the pressure. Binance's systems entered a server-busy state, creating a liquidity vacuum exactly when liquidity was most desperately needed. Market makers couldn't place bids. Traders couldn't close positions. The bid-ask spreads on Bitcoin, perpetual swaps widened from 0.02 basis points to 26.43 basis points, a 1,321 times expansion that turned every forced liquidation into a wealth extraction event. Meanwhile, crypto data platforms like CoinGecko went offline or displayed incorrect information. CoinGlass, the primary liquidation tracking service, suffered what investigators later described as a sophisticated proxy attack, disrupting access to real-time data exactly when traders needed it most. Users couldn't see what was happening, couldn't assess the damage, couldn't make informed decisions about whether to hold or fold. They were flying blind through a financial hurricane. By the time the immediate cascade ended 14 hours later, $19.3 billion in leveraged positions had been liquidated, the largest deleveraging event in cryptocurrency history, 9 times larger than any previous crash, surpassing the COVID collapse of 2020 and the FTX bankruptcy of 2022 combined. Over 1.6 million traders were wrecked, crypto slang for wrecked, a term that means complete financial annihilation. The wealth transfer was staggering and surgical. While millions lost everything, a smaller cohort of sophisticated traders profited immensely. The wallet linked to those massive pre-positioned short contracts reportedly earned over $80 million in 24 hours. Exchanges collected billions in liquidation fees. Market makers who had pulled liquidity during the crash placed new orders at the bottom, accumulating assets at fire sale prices before retail traders could even access their accounts. This wasn't just volatility. This was a hunt. But the most chilling revelation came not from what happened during the crash, but from the forensic analysis of who knew what and when they knew it. The evidence suggests this was not opportunistic trading. It was an operation planned with advanced knowledge of systemic vulnerabilities and geopolitical catalysts. On-chain analyst YQ traced the pre-positioned shorts to a wallet connected to Garrett Jin, known in crypto circles as Garrett Bullish, a former executive at major exchanges Huobi and Bitforex, someone with intimate knowledge of how exchange infrastructure works, how pricing oracles function, how liquidation cascades propagate through interconnected systems. The positions doubled in size exactly 30 minutes before Trump's tariff announcement. Timing so precise, it raises questions that investigators still can't definitively answer. Did someone have advanced knowledge of Trump's tariff policy? Crypto commentator Ran Neuner pointed to the suspicious timing. The sell-off began immediately after U.S. markets closed on Friday, at the precise moment when both European and Asian trading desks were sleeping, when crypto stood isolated and vulnerable, when any coordinated attack would face minimum resistance from traditional market participants. The statistical probability of coincidence collapses under scrutiny. Out of thousands of trading pairs across the crypto ecosystem, only the 3 assets that Binance had publicly announced for Oracle updates experienced extreme depegging. Only those 3. Only on Binance. Only during the exact 8-day vulnerability window between announcement and implementation. The attack pattern matched a textbook example of Oracle manipulation, a financial crime technique where traders exploit the gap between real-world prices and the data feeds that trading systems use to make decisions. Previous Oracle attacks had caused millions in damage. The 2020 Harvest Finance exploit, previously the benchmark for this type of manipulation, involved $24 million in losses. October 2025 exceeded that by 800 times. Guy Young, founder of Athena Labs, which created USD, confirmed the isolation. The depegging to $0.65 was connected only to Binance's internal systems. On-chain redemptions for USD remained functional at the proper 1-to-1 ratio throughout the entire crash. Aarve's Oracle data showed USDE maintaining perfect peg across all DEFI protocols. This wasn't a fundamental failure of the asset. This was a pricing problem weaponized against a specific exchange's infrastructure. The sophistication suggests planning, preparation, and intimate knowledge of financial architecture vulnerabilities. Mike Marshall, head of research at Amberdata, described it as the anatomy of a modern market collapse, where leverage meets liquidity failure at algorithmic speed. His analysis revealed 4 distinct trigger events throughout the day, each one carefully timed to maximize cascading damage through the ecosystem. And there's another shadow that fell across the crash, one that made recovery even more difficult and exposed deeper structural problems in how crypto intersects with traditional finance. On the exact same day as the crash, October 10th, MSCI, the world's second-largest index provider, published a quiet document targeting digital asset treasury companies like Michael Saylor's Strategy, formerly MicroStrategy. MSCI proposed reclassifying these Bitcoin holding companies, potentially excluding them from major indexes. JP Morgan estimated this could trigger $2.8 billion to $8.8 billion in forced passive outflows, as index funds and pension managers would be mandated to sell those stocks regardless of their own views on Bitcoin. The timing, the exact same day as the largest crypto liquidation in history, created what analysts now call a structural overhang that explains why crypto prices struggled to recover in subsequent weeks. Was this coordination between traditional finance and crypto manipulation? Was this a message being sent about crypto's place in institutional portfolios? The questions linger like smoke in a room where something burned that nobody wants to discuss. Meanwhile, as markets bled and traders faced ruin, the regulatory apparatus appeared strangely absent. No circuit breakers halted trading. No emergency interventions stopped the cascade. Crypto markets, for all their institutional adoption and ETF approvals, still operated in a regulatory gray zone, where traditional market protections didn't apply, and new frameworks hadn't yet been built. The aftermath revealed the fragility underneath crypto's trillion-dollar facade. Total market capitalization lost $370 billion in hours. Open interest, the total value of all derivative positions, reset by $65 billion, returning to levels last seen in July 2025, erasing months of institutional accumulation. The crypto fear and greed index plunged into extreme fear territory and remained there. Binance announced user compensation and system audits, but critics noted these were temporary bandages on infrastructure wounds that ran much deeper. The fundamental vulnerability, exchanges using internal pricing data for critical margin calculations, persisted across multiple platforms. The recursive leverage structures that amplified the crash remained legal and accessible. The gaps between traditional market regulation and crypto's 24/7 global nature continued to create exploitation opportunities for those sophisticated enough to understand them. What the October crash proved with brutal clarity is that crypto markets had achieved the worst of both worlds: large enough to cause systemic damage, sophisticated enough to attract predatory traders, but still fragile enough to be manipulated through techniques that traditional finance had learned to prevent decades ago. Circuit breakers, position limits, real-time surveillance, coordinated intervention mechanisms. None of these existed in crypto's 24/7 algorithmic ecosystem. The business lessons embedded in this dark story cut to the heart of financial power dynamics in the modern age. First, infrastructure becomes weaponizable at scale. The same systems designed to provide efficiency and access can be exploited by those who understand the code beneath the code. The vulnerabilities hidden in the plumbing that most users never see. Binance's unified account system was marketed as innovative flexibility. Use any asset as collateral. Maximize capital efficiency. But that flexibility became a transmission mechanism for financial contagion when someone understood how to manipulate the pricing feeds those systems relied upon. Second, transparency creates vulnerability when paired with systemic weakness. Binance announced its Oracle transition publicly, 8 days in advance, believing this transparency would build trust. Instead, it created a countdown timer for sophisticated attackers who could see exactly when systems would be most exposed, exactly which assets could be manipulated, exactly how long they had to position for maximum profit. In markets where predators hunt, transparency without protection is blood in the water. Third, leverage doesn't just amplify gains, it weaponizes losses into systemic events. The traders liquidated on October 10th thought they were making reasonable bets, using stable, collateral, and conservative leverage levels. What they didn't realize was that their individual positions were cells in a larger organism, interconnected through hidden dependencies that made the entire structure vulnerable to targeted attacks on specific nodes. The recursive nature of modern leverage means that what looks like safety in calm markets becomes catastrophic fragility when someone pulls the right thread. Fourth, The boundaries between legitimate trading and market manipulation blur in unregulated spaces where technical sophistication replaces legal constraints. If the October crash was indeed a coordinated attack, and the forensic evidence strongly suggests it was, then it represents a dangerous evolution in financial crime. The attackers didn't hack systems or steal private keys. They simply understood the rules better than their victims, identified structural vulnerabilities that were hidden in plain sight, and executed trades that were technically legal but practically predatory. Analyst Colin Wu described it as a $60 million manipulation that destroyed $19 billion, a 322 times amplification achieved not through traditional market power, but through infrastructure exploitation. This is finance as code warfare, where understanding the system's architecture matters more than capital size, where a precisely targeted $60 million attack can extract billions from those who didn't realize they were vulnerable. The psychological dimension is equally dark. For the 1.6 million traders liquidated, this wasn't an abstract market event. It was financial annihilation that happened faster than they could react, triggered by mechanisms they didn't understand, benefiting sophisticated players they couldn't see. Many lost years of savings in minutes. Some lost everything they had. The wrecked memes and dark humor that followed couldn't mask the genuine devastation of wealth destruction at that scale. And yet, certain voices in the crypto industry celebrated the crash as necessary deleveraging, a cleansing fire that purged weak hands and reset market structure for healthier growth. This framing, treating massive wealth destruction as systemic improvement, reveals the predatory undercurrent in crypto culture, where losses are individualized as personal failure, but profits from others' liquidations are celebrated as market efficiency. The technical analysis from Amber Data revealed that 70% of the damage occurred in just 40 minutes, at a liquidation rate 14.6 times faster than the hours before and after. This wasn't gradual price discovery. It was a concentrated extraction event, where automated systems executed forced sales into the thinnest liquidity conditions possible. The spread costs alone, widening 1,321 times from normal levels, meant that even traders trying to close positions manually faced catastrophic slippage that turned manageable losses into complete wipeouts. What makes October 2025 uniquely disturbing in crypto's history of crashes is that it occurred not during a bear market or crypto winter, but at the peak of institutional adoption. Bitcoin had just reached all-time highs above $126,000. Spot ETFs had been approved and were seeing steady inflows. Major financial institutions had validated crypto as an asset class. The narrative was maturity, legitimacy, mainstream acceptance. And then the floor collapsed, revealing that beneath the institutional veneer, crypto markets remained vulnerable to manipulation techniques that would be impossible in regulated traditional markets. The cognitive dissonance was profound. How could an asset class sophisticated enough to attract pension funds and sovereign wealth still be manipulable through basic oracle exploits? The answer exposes crypto's fundamental contradiction. It wants institutional scale and retail freedom, sophisticated derivatives and minimal regulation, global 24/7 markets, and localized legal protections. These desires are incompatible. October 10th was the price of that incompatibility, paid by those who didn't realize they were betting on infrastructure they didn't understand. Regulators worldwide took notice. The scale of retail destruction, 1.6 million traders liquidated, combined with evidence of potential market manipulation, created political pressure for coordinated response. Analysts predicted global moves to cap leverage for retail traders at levels similar to traditional markets, impose stricter oversight of exchange risk engines, and require standardized oracle systems resistant to manipulation. But regulatory response moves slowly, and the next vulnerability is already being identified by those who profit from system exploitation. Crypto's structure, permissionless, global, algorithmic, makes it inherently difficult to regulate without destroying the features that make it attractive in the first place. This creates a perpetual cat-and-mouse game where sophisticated players identify and exploit weaknesses faster than regulators can build protections. The October crash also revealed troubling questions about Oracle manipulation that extended beyond Binance. If one exchange could be exploited this dramatically through pricing feed manipulation, what prevented similar attacks on other platforms? How many crypto trading systems relied on manipulatable price sources for critical margin calculations? The answers remained unclear, hidden in proprietary exchange architectures that users trusted but couldn't verify. Some analysts argued the crash exposed crypto's ultimate value proposition. Despite $19 billion in liquidations, the underlying blockchain systems continued functioning perfectly. Bitcoin didn't stop processing transactions. Ethereum's network operated normally. DeFi protocols executed their smart contracts as designed, with liquidations proceeding mathematically, rather than through human discretion. In this view, the crash proved crypto's resilience. The code worked, even when the consequences were devastating for those on the wrong side of leverage. But this argument masks a darker truth. Systems can function perfectly while producing morally troubling outcomes. Automated liquidations executing as programmed doesn't make them just when they're triggered by manipulated price feeds. Technical correctness isn't the same as systemic fairness, and the October crash demonstrated how algorithmic precision can be weaponized against those who don't understand the underlying code. The aftermath saw crypto markets struggle to recover, with Bitcoin trading in a depressed range for weeks. The MSCI overhang created constant selling pressure as institutional investors preemptively adjusted positions. Retail traders, burned by sudden liquidations, pulled back from leveraged trading. The fear and greed index remained in extreme fear territory. The psychological damage proved harder to repair than the financial losses. Some optimists pointed to historical precedent. Crypto had recovered from every previous crash, each time emerging stronger and more mature. They argued October 2025 was another necessary step in crypto's evolution, a painful lesson that would lead to better infrastructure and smarter risk management. Analysts predicted Bitcoin could reach $150,000 to $180,000 by year-end if conditions improved. But this optimism requires ignoring the central question that the crash revealed and left unanswered. In a market where infrastructure can be weaponized, where sophisticated players can exploit systemic vulnerabilities for massive profit, where regulatory protection remains minimal and enforcement practically impossible across global jurisdictions, who is this system really built for? The forensic evidence suggests the October crash wasn't market failure. It was market design working exactly as intended, just not for the users who thought they were participants rather than targets. The $80 million profit from pre-positioned shorts, the billions in liquidation fees collected by exchanges, the fire sale accumulation by market makers. These weren't bugs in the system. They were features for those who understood how to exploit them. As November arrived and the immediate panic faded, crypto markets began their slow climb back from the abyss. Bitcoin recovered past $110,000. Altcoins stabilized. Institutional money continued flowing into ETFs, though more cautiously. The machinery of crypto resumed its 24/7 operation, processing billions in daily volume across thousands of trading pairs. But beneath the surface recovery, the fundamental vulnerabilities exposed on October 10th remained unresolved. Leverage was still available at dangerous levels. Oracle systems still relied on potentially manipulatable price feeds. Exchange infrastructure still concentrated risk in ways that created cascade opportunities. The 24/7 global nature of crypto markets still meant that coordinated attacks could occur when traditional finance was sleeping and unable to provide stabilizing liquidity. The October crash will be studied for years as a case study in modern financial vulnerability, how systems designed for efficiency become vectors for exploitation, how transparency without protection creates attack opportunities, how the intersection of algorithmic trading and regulatory gaps produces extraction mechanisms that devastate retail participants while enriching sophisticated players who understand the hidden architecture. Whether it was coordinated attack or market panic ultimately matters less than what it revealed about the nature of digital finance in 2025. The evidence strongly suggests coordination, the timing too precise, the targeting too specific, the profit patterns too suspicious to be coincidence. But even if we accept the more charitable interpretation of cascading panic, the outcome demonstrates that crypto markets remain fundamentally unsuitable for retail participants who don't understand infrastructure vulnerabilities, who trust that stable assets will remain stable, who believe that regulated exchanges provide protections comparable to traditional finance. The business lesson is ancient and perpetually relevant. In any market, understanding the rules matters less than understanding who wrote them and who benefits when they break. Crypto promised democratized finance, but October 10th demonstrated that democratization without protection simply creates more targets for those who understand how to hunt in unregulated spaces. As crypto continues its evolution toward mainstream adoption, the October crash stands as a warning written in $19 billion worth of liquidated positions. The systems we trust with our wealth may be more fragile than they appear. The protections we assume may not exist. And in the final hour before the weekend descends, someone always knows something we do not. The question now isn't whether another crash will occur. It's whether the next one will be even larger, even more sophisticated, and whether those who learn these lessons will be the protectors or the predators when it arrives. Because in the shadowy intersection of code and capital, where algorithmic systems execute at speeds faster than human comprehension, where global markets never sleep and regulatory oversight struggles to keep pace, the hunt never truly ends. It only waits for the next vulnerability window to open. Subscribe and listen to our next story below.